My name is AJ Hamner, and today I will be presenting on the alternative investment asset allocation. First, an overview of the hedge fund industry. Hedge funds curb risk for more consistent, higher than normal returns. Another characteristic of the industry is that there are not many investors due to the large initial investment requirement. There are four main strategies. First, relative value. Second, long-short or equity hedge. Third, event-driven, and fourth, macro. A little on the history of hedge funds. The original purpose was to preserve capital, and hedge funds did this through hedge fund-specific tools to generate the consistent higher-than-normal returns. The first hedge fund manager was Alfred W. Jones, who began his revolutionary investment firm in 1949. His two key strategies or tools were leveraging and short selling. Notable investment managers, Warren Buffett and George Soros, took note and developed their own hedge funds. Since then, the number of hedge funds have grown. To illustrate the significant growth, there were 30 hedge funds in 1990. However, almost 10,000 hedge funds exist today. That equates to about 8% average growth. Some recent news regarding the hedge fund industry in general is that emerging markets are opening to hedge funds, which provides great potential for growth. In Japan, a new long-short hedge fund was created, and SAC hedge fund was recently fined $614 million for insider trading. Now to the reasons to why and why not investors prefer hedge funds. First, hedge funds are not regulated by the SEC as much as established investment vehicles. Next, there is low volatility, which can be seen by the first chart on the right. In other words, hedge funds can take advantage of the down market times, and they typically have low correlation to major asset classes. However, there are high management fees, but according to a study by Preqin, a clear majority of institutional investors expect to invest up to $100 million. There are four main strategies which hedge funds utilize to generate the above average returns. First, relative value, which focuses on the profitable opportunities within the fixed income market. Long short, like its title says, focusing on longing and shorting equities. Event driven deals with opportunities within equities, but tend to be longer term horizon than equities hedge. Then finally, macro, which focuses on global trends such as commodities. Now I wish to provide my recommendation for asset allocation to provide a vision to the research findings which I will later provide. First, I came to my recommendation through the efficient frontier, which is a method to identify the optimum portfolio, or in other words, highest expected return with lowest volatility. In phase 1 of your investment, I recommend that you invest $100 million, or in other words 10%, within relative value hedge funds. In phase 2, or after 3 years, I would reassess the equities and bond market, and then transition the 10% alternative investments portion to event-driven hedge funds. Now let's move to my research. To simplify my analysis, I have put the equities market on the left and the bond market to the right throughout the presentation. Regarding the performance, in the past 10 years, event-driven strategy has outperformed all hedge fund strategies, the world equities market and bond market. This includes the cumulative and annualized returns. Then in the past 5 and 3 years, relative value hedge funds have outperformed all other hedge fund strategies and the world equities market. Regarding risk, it is important to note that all the hedge fund strategies had lower volatility than the world equities market. Moving to the relationship of the hedge fund strategies to the markets, it is important to note that most hedge fund strategies exhibited strong correlation to the MSCI and Barclays bond. However, the macro strategy exhibited the least correlation. Within alpha, this is important because we see how much of the return is due to the skill of management. For all strategies, we see that the alpha is positive, and the beta, or the magnitude affected by the market, of each strategy is pretty similar except for the macro strategy. Now that we have talked about the relationship to markets, I wish to focus on the efficiency of these hedge fund strategies. The efficiency ratios show a similar pattern to which I pointed out from the hedge fund strategies' performance. Event-driven outperformed all strategies and the equities market in the past 10 years. Relative value outperformed the other strategies, including the equities market, in most recent years. Back to my recommendation. As I've studied economic outlooks, they indicate a similar future for the economy, as we have experienced most recently. Therefore, within the next 3 years, I recommend $100 million within relative value hedge funds, due to the expectations that similar growth will occur as we've witnessed. Then after 3 years, I recommend transitioning the alternative investment allocation to more event-driven, which will equals $81.25 million in event-driven and $18.75 million in relative value. Phase 1 will generate 5% expected return with a 0.59 Sharpe ratio. Phase 2 will generate similarly, both of which are significantly higher than the MSCI World Index expectations. One thing to note regarding Phase 2 is to consider macro hedge funds. They have done well in the past, but not currently due to significant government intervention. As a result, macro hedge funds have not been able to accurately predict global trends. However, if government intervention is reduced, then macro hedge funds would be a wise consideration to hedge your overall portfolio due to its low correlation to world markets. And so this is my recommendation. Thank you for listening and appreciate your time. Thank you.